Good morning and welcome to video number 236. This is lecture number 10 based on money and banking in a series of lectures in introductory macroeconomics. So in this lecture I'll focus on money and banking. So I start with the definition of money. Historically speaking, before money was not invented, barter trade was used and in which goods were exchanged for goods. Then there was a commodity money in which an item was used as money but which also had value from its use as something other than money. We had commodity backed currencies, for example dollar bills or other currencies with values backed up by the gold or another commodity. And but there was a problem of double coincidence of wants with barter system, and it is a situation in which two people each want some good or service that the other person can provide. Another concept is fiat money, something used as money but which has no intrinsic value beside that. Medium of exchange, whatever is widely accepted as a method of payment. So for money it is necessary that whatever is used as money, it must be widely accepted as a medium of exchange. Defining money by its functions. Money has got to play many different functions. It solves the double coincidence of wants problem, since money is generally accepted as a medium of exchange. Second, people are willing to sell something for money. Third, money serves as a unit of account. And finally, it also serves as a unit of as a standard of deferred payments, that is payment to be made in the future. Commodity versus fiat money. Money has taken a wide variety of forms in different cultures. Examples of commodity money is gold, silver, shells, cigarettes, and even cocoa beans. Fiat money has no intrinsic value but is declared by a government to be legal. Coins and currency in circulation. The coins and bills that circulate within the economy and that are not held by the US Treasury at the Federal Reserve Bank are in bank vaults. Credit card, it immediately transfers money from the credit card company's checking account to the seller, and at the end of the month the user owes the money to the credit card company. A credit card is a short-term loan. This is widely used, and different commercial banks provide credit cards to the customers, and it is a way of medium of exchange, a unit of account. Debit card, like credit card, debit card is also given by the commercial banks, and like a check, it is an instruction to the user's bank to transfer money directly and immediately from your bank account to the seller. Different banks have their own debit cards. Demand deposits, these are a checkable deposit in the banks that is available by making a cash withdrawal or writing a check. Liquidity, how quickly and easily an asset can be converted as a means of payment to make a purchase. M1 money supply, this is a narrow definition of the money supply that includes currency and checking accounts in banks and to a lesser degree travelers' checks. M2 is another form of a money supply that includes everything in M1 but also adds saving deposits, money market funds, and certificates of deposits. Money market fund are the deposits of money of many investors are pooled together and invested in a safe way like short-term government bonds. Then we have savings deposit, bank account where you cannot withdraw money by writing a check but can withdraw the money at a bank or can transfer it easily to a checking account. Smart card, it stores a certain value of money on a card and then one can use the card to make purchases. Time deposits are the accounts that the depositor has committed to leaving in the bank for a certain period of time in exchange for a higher rate of interest. These are also called certificate of deposit. These are the definitions of M1 and M2. And here is the relationship or the image of M1, M2. M1 is a subset of M2. Credit. When you make a purchase using money that you don't have, you are using credit. It is someone else's money that have lent to you. Typically, you use credit to buy something like a car, a house, a college expenses, big ticket items that will benefit you for a long time. Instead of saving up and only then paying for them, credit allows you to buy now and pay for them over time. Sometimes people obtain credit in advance so that in future when opportunities or needs arise, they will be able to buy something. Credit comes in many forms, including loans, bonds, notes, or lines of credit. All are essentially IOUs. That is, promise to repay with interest. Debt is accumulated credit less what has been repaid. If you look at credit card statement, each payment, each purchase you make using a credit card is a loan from the credit card company to you. Your total debt is the sum of money you have borrowed from all your creditors. Bills. These are short-term debt instruments. Bonds are long-term debt instruments. And debt instruments basically is IOU, that I'll make payment to you along with interest. Equities are stocks. Ownerships in a private company. Initial public offering. These are original sale of stock by a corporation. Notes. Intermediate term debt instruments. Securities. Synonym for financial assets. Where do individuals put their savings? And where do business obtain the funding for investment expenditure? The answer to both these questions is financial markets. And these include the banking system, equity markets like the New York Stock Exchange or the Nasdaq stock market, bond markets, commodity markets, etc. Financial markets are global. Americans put their savings into foreign as well as domestic bank account, foreign and domestic stocks, and foreign domestic bonds. Interest rates are the price of borrowing in the financial market, a rate of return on an investment. Intertemporal decision making, the study of how people make choices about what and how much to do at various points when choices are at one time influence possibilities available at other points in time. Financial markets are made up of a large number of markets for different types of securities, including equities, bonds, credit cards, etc. Each financial asset is a substitute for every other financial asset. Checking account is a bank account that typically pays little or no interest, but that gives easy access to money either by writing a check or by using a debit card. Credit union is a non-profit financial institution that its members own and run. Debit card is a card that lets a person make purchases and the financial institution immediately deducts cost from that person's checking account. Depository institution, that is the institution that accepts money deposits and uses these to make loans. Financial intermediary, an institution that operates between a saver with financial assets to invest and an entity who will borrow those assets to pay at a rate of return. Payment system is system by which buyers and sellers exchange money for goods, services, and financial capital. The commercial banking system, there are savings accounts, a bank account that pays an interest rate, but withdrawing money typically requires a trip to the bank or an automatic teller machine. Transaction cost, the cost associated with finding a lender or borrowing for money. This is the role of banks as financial intermediaries, how buyers and seller are interconnected through banks. See, savers deposits money in the bank, banks provides loan to the borrowers, borrowers repay loans along with the interest rate, and the banks, the savers can also withdraw money from the bank, and there are interest payments involved. So banks play two key roles in functioning of the economy. First, by facilitating the payment system, and second, by serving as financial intermediaries. Banks also make it far easier for a complex economy to carry out the extraordinary range of transactions that occur in goods, labor, and financial capital markets. And banks lower transaction cost. Asset. It is an item of value that a firm or individual owns. Liability time mismatch. Customers can withdraw a bank's liabilities in the short run while customers repay its assets in the long run. Balance sheet. This is an accounting tool that lists assets and liabilities. Bank capital, a bank's net worth. Diversify, make loans or investment with a variety of firms to reduce the risk of being adversely affected by events at one or a few firms. Liability, an amount or debt that a firm or an individual owes. Net worth, the excess of the asset value over and above the amount of the liability, total assets minus total liabilities. Reserves, funds that a bank keeps on hand and that it does not loan out or invest in bonds. This is a kind of bringing assets and liability statements. Then there is a T account and treasury securities. The T in T account separates the assets of a firm on left from its liabilities on the right. All firms use T accounts though most are much more complex. How banks create money? Banks create money through making loans. Then there is multiplier, ratio of the total money in the economy divided by the amount of reserves, or the ratio of change in total money in the economy divided by a change in amount of reserves. Formula for the money multiplier is 1 divided by required reserve ratio. And the required reserve ratio is the percentage of total deposits a bank must hold as reserves. These are some questions for review that I tried to answer in my presentation. Here are some more questions. Ladies and gentlemen, kindly subscribe to this channel if you haven't subscribed, and do not forget to click on the bell icon so that you can get notification about other useful videos that I'll upload for you. I thank you very much for watching this video. Kindly like, share, and comment in the comment section, and I'll try my level best to come up with the answer. See you in another video. Thank you.